Welcome back, my awesome people. In today's episode, I'll be highlighting one of the hottest topics of 2024, and that is, should I buy real estate investment trusts, also known as REITs, or should I actually go and buy physical real estate? Many investors who want to tap into the real estate sector compare REITs to actual tangible real estate. REITs are simply funds for real estate investing. REITs allow individual investors to make money on real estate without having to own or manage physical properties. Whereas with direct real estate, you buy specific property or a partial stake in one, such as an apartment complex, which is residential, or a shopping center, which is commercial, and you make money from the rental income, appreciation, and profits generated by the real estate. Direct real estate offers more tax breaks than REIT investments and gives investors more control over decision making. And many REITs are publicly traded on exchanges, so they're easier to buy and sell than traditional real estate. Whether you buy physical real estate or a REIT, there are pros and cons to both. And I will tell you at the end what I have been doing in the real estate space. That has been providing me with a solid 10% plus annual return. So let's get into the pros and cons of each, and you can decide for yourself which investing option is profitable for you. So let's start with physical real estate. First, a benefit of investing in physical real estate is the potential to generate substantial cash flow, as well as the ability to take advantage of numerous tax breaks to offset that income. For example, you can deduct the ordinary and necessary costs to manage, conserve, and maintain the property. Another large tax break is for depreciation, in which you deduct the cost of buying and improving a property over its useful life, which lowers your taxable income in the process. And of course, there's also the prospect of price appreciation of the property. While the real estate market fluctuates as the stock market does, property prices generally increase over time. So you may be able to sell later at a higher price. Another perk of direct real estate is that you have more control over decision making than you would with REITs. For example, you can select only properties that match your preference for location, property type, and financing structure. You can set rental prices, choose the tenants, and decide how many properties to buy. You can also refinance your mortgage when interest rates drop, or tap into your home equity through loans or credit lines for other purposes. Now, the cons of investing in physical real estate. One of the main disadvantages is that it requires a significant amount of time and energy, especially sweat equity, if you want to be successful. You have to deal with tenant issues, maintenance emergencies, and your liability if there are any accidents on the property. Financing can be another disadvantage. Many investors need to take on a mortgage or some other type of financing to pay for investments. If the market tanks or you have difficulty finding quality tenants, there's a chance you could default on the loan. Another negative is that real estate is not a liquid asset. That means you probably won't be able to sell it quickly if you needed cash for an emergency. So to recap, the pros of physical real estate include positive cash flow and appreciation, tax advantages, and control over decisions, and the cons include requiring time and energy, risking financing in default, and it is not as liquid, which means it is not easy to buy and sell. Now, REITs. A REIT is a corporation that owns, operates, or finances income-producing real estate or real estate-related assets. Modeled after mutual funds, REITs pool the capital of numerous investors. Currently, there are more than 300 REITs in North America that trade on major stock exchanges and that are registered with the Securities and Exchange Commission, also known as the SEC. These REITs have a combined equity market capitalization of more than $1 trillion worldwide. REITs can be appropriate for new investors with limited experience in real estate who want to diversify their portfolio without a ton of risk. Now, the pros of REITs. Perhaps the biggest advantage of REITs is that individual investors can access profits from real estate without the need to own, operate, or directly finance properties. They offer a low-cost way to invest in the real estate market. You can invest in a fund with as little as $100, which is a lower entry point than directly buying real estate in the hundreds of thousands. Another benefit is that REITs offer enticing total return potential. By law, REITs have to pay at least 90% of taxable income to shareholders, and it's not uncommon to have a 5% plus dividend yield. REITs also have the potential for capital appreciation as the value of the underlying assets increase. Another important perk is liquidity. Like stocks, you can buy and sell REIT shares on an exchange. In general, REITs trade under heavy volume, which means you can get into or out of a position whenever you want to. And now the cons of REITs. Of course, there are some drawbacks to REITs. For starters, most REIT dividends aren't considered qualified dividends, so they're taxed at a higher rate. This is something to pay extra attention to if you own REITs in a taxable brokerage account, which are not your tax-free accounts or your RRSP. So keep in mind that you can hold REITs in a tax-advantaged Roth IRA account. Another con is that REITs can be very sensitive to interest rate fluctuations, and rising interest rates are bad for REIT prices. In general, REIT prices and treasury yields have an inverse relationship. When one goes up, the other goes down, and vice versa. One other drawback is that while REITs can help you diversify your overall investment portfolio, most individual REITs aren't diversified at all. That's because they focus on a specific property type, such as offices or shopping centers. If a REIT invests solely in hotels, for example, and the economy tanks or people stop traveling, like what happened during COVID, you can be exposed to property-specific risks. So, to recap, the pros of REITs include real estate profits without having to own, manage, or finance property, higher than average dividends and potential for appreciation, and liquidity is as easy as trading stocks. And recapping, the cons include no tax advantages, are sensitive to interest rate fluctuations, and can be property-specific risks. So, Jacob Rant, what is your real estate exposure? Are you buying physical properties or are you a REIT guy? Well, my awesome people, I'm a combination of both, but with a heavier lean towards REITs. Everyone's circumstance and lifestyle is different, and my lifestyle is so busy that I find REITs to be a better option for me currently. Yes, I do have physical real estate, but not as much invested when compared to REITs. I do plan on getting more into physical real estate, maybe in 2025 or 2026, but for now, REITs are giving me the monthly return that I desire, without the stress and headache of dealing with tenants and mortgages and this maintenance and that maintenance. Direct real estate investing might be a better choice if you want cash flow, tax breaks to offset that income, and great potential for appreciation. It's also good if you want more control over your investments and like a boots on the ground approach. But REITs make sense for investors who don't want to operate and manage real estate, as well as for those who don't have the capital to buy physical properties. But the cat's out of the bag because REITs have a long history of outperforming direct real estate investing, and the trend is expected to continue. For example, from 1977 to 2010, REITs have returned more than 12% annually. This is in comparison to the roughly 10% return of the S&P 500 and the 6 to 8% return of private real estate funds during the same period. And over the past 5 years, REITs have had an average annual return of around 10%, while the average annualized return of physical real estate has been about 8%. These are impressive performance numbers that all investors should find interesting. Therefore, if you're thinking about increasing your real estate exposure, it's important to consider a REIT. While physical real estate is sometimes better, such as if you live in a local market that's booming, the performance of REITs is typically the best. And remember, my awesome people, just like all the information I mentioned in my videos, assess your risk appetite, always diversify, and please do your own due diligence because I am just a clown on YouTube. Stay ranting.